The first one I want to talk about is BDIV, the AAM Brentview Dividend Growth ETF.
Yeah.
Give us a little bit of background on the strategy on that one.
Yeah, 100%. And it's so some background in terms of like when we even launched it and stuff like that. I'll get into like the high level stuff. It's a dividend growth strategy. We launched it on July 31st of 2024. So fairly new in the ETF wrapper, but the strategy itself has been in the SMA format for well over a decade, close to 2 decades now. The portfolio managers have decades of experience in dividend growth investing, and dividend growth investing is really interesting because we really do think that we're doing something pretty intriguing in terms of the active management component of this strategy. Brentview Investment Management likes to take a differentiated approach in terms of being unconstrained. So what do I mean by that? To take a step back, I think giving a lay of the overall dividend growth landscape is also pretty helpful too, because it's a large landscape. It's been around close to since the inception of the ETF. Some of the earlier dividend growth ETFs have been around since the early 2000s. So not too far off from that from when SPY launched in '93. But essentially what a lot of these indexes do is they basically say, here's a universe of stocks, find me the ones that have been growing their dividends for X amount of years, over that specific pre-specified time frame. And the amount of years that they'll choose will be 5 years, 10 years, 15 years, 25 years, or even 50 years we've seen. From our standpoint, we view that as something that is a little subjective in terms of stock picking in a portfolio. So we worked with the experts at Brentview Investment Management. We have a long-standing relationship with to bring their SMA-based strategy into the ETF wrapper and provide access to a strategy that's unconstrained, because it also this is like the kicker in terms of why we believe we're differentiated. Is that it can also include dividend initiators. So companies that are starting to pay a dividend for the first time. These companies tend to, demonstrate a level of earnings growth that may be more attractive than a company that has been maybe slowly growing their dividend for a 25-year time period just to stay in those aforementioned indexes. So the dividend initiator component we think is really interesting, and also fast growers. So maybe it's a company, for example, that is been consistently growing their dividends for maybe just a few years. So maybe the indexes aren't picking them up yet, but from the portfolio manager standpoint, they're able to naturally add a company like that earlier on, should it meet their fundamental criteria that they look for. So speaking of fundamental criteria, I think that kind of goes well into just to how like the portfolio is sized and what they're looking for. Naturally, consistent earnings growth, consistent cash flow growth, commitment to paying a dividend naturally is going to be the key point of the stock picking that the portfolio managers are looking for. And the deterioration of any of those will potentially trigger them to maybe sell a stock, should they feel that is the right decision to do. But in terms of sizing, the portfolio will typically be anywhere from 30 to 40 names.
Okay.
Mainly U.S. equities. They can include international equities up to a 10% cap, but mainly U.S. equity portfolios still. They'll typically cap their sector exposure up to 25%. And each individual company at purchase will be anywhere from 2 to 4% of the portfolio. That's the overall sizing. In terms of their time horizon that they're looking for, based on those like fundamental and profitability metrics that I was mentioning earlier, typically anywhere from 3 to 5 years. So this is definitely like a buy and hold strategy and a high conviction portfolio of concentrated names. So yeah, I mean the overall portfolio, definitely we think overall, from a portfolio usage standpoint, what we've seen, at least in the financial advisor community, it's a dividend growth strategy. The goal of the portfolio is naturally to still get a higher level dividend yield in the S&P, get a higher level of dividend growth in the S&P, but also with a lower beta. So we do look at this as like a true core U.S. equity holding, a quality factor type of strategy, utilizing dividend growth as that main metric there. And in terms of but also can also fit naturally within an equity income sleeve as well, given the goal of the strategy being to still potentially achieve a level of higher income relative to the S&P 500 as well. So we really do look at it as something that could be like a nice piece of a core U.S. equity portfolio sleeve. But yeah, I mean, we think now is definitely like, I mean, from a dividend growth standpoint, I'll kind of just leave this there with the overall strategy, and maybe like a why now for dividend growth investing. I mean, in terms of what we're seeing in the regarding the volatility in the market at the time of this discussion has been pretty significant with the sell-off in the Magnificent Seven. I mean, BDIV has a little bit of exposure to the Magnificent Seven, but it's a lot lower than that of like the S&P 500 or the Nasdaq. So we do look at it as a little bit of a nice diversification play within a core U.S. equity sleeve as well, for those looking just to expand their sector biases a little different. So like right now, like BDIV's a little bit overweight in the consumer staples sector, which has been performing pretty well, as of this discussion, just to kind of give a little bit of how the portfolio is currently positioned, a little bit of background there.
Okay. Yeah, that's great. So just a couple of the metrics. The yield as of today is 1.40, a little bit higher than the S&P 500. The expense ratio says is 0.49 because it isn't actively managed. And some of the top holdings include Microsoft, Apple, Train, T-Mobile, and United Healthcare. So those are top quality names. Everyone in the dividend space knows those names and more than likely is investing in them. But to your point, you do have the flexibility to pick other names that fit the criteria, which is really good. You're not going to have the same, and you don't have the same restrictions as something like DGRO or SCHD, where they have to have a certain amount of years of dividend growth and things like that in place before you go into the fund. So that's a really nice strategy. And to your point, hopefully the dividend growth will be higher than the S&P 500 and some other ones that you. So those are for people who want access to S&P 500 type of names, but want a slightly higher yield and a higher growth than the S&P 500 might offer you.